face it, required minimum distributions are one of those things that we wish did not exist. No one wants the government telling us when and how we have to spend our money, but unfortunately, it's the truth. I have two promises for you in this video. The first is I'm only going to share the things that you need to know about required minimum distributions. And the second piece is I'm not going to bore the daylights out of you when I do so, or at least I hope so. But one of the things that people often get confused with RMDs, and especially when they hear that RMDs don't start until their 70s, they think, well, that's not for me, right? That's someone in their 70s. But the truth is, planning for RMDs well out in advance is only going to be to your benefit. So I hope that some of the things I mentioned today can be helpful for you if you're in your 40s, 50s, or 60s. So let's simply start with what is an RMD, which is short for a required minimum distribution. Now, this is simply put an IRS mandated required amount that you must withdraw from any qualified retirement account annually once you hit a certain age. That was a mouthful, I know. Put differently, if you have a 401k or a traditional IRA, a SEP or a simple IRA, any retirement account that you were able to defer contributions into during your working career, but you haven't yet withdrawn, know that the government has a say of when you are going to withdraw those, how much you're going to withdraw, and of course, depending on your tax rate at the time, will be their share of your retirement account. Now, that amount that I just mentioned is going to be based off of two things. One, it's going to be based off of your account value, and then the second piece is going to be based off of your life expectancy. So let me throw up a table here of what the current life expectancy is from the IRS. It's always very heartwarming to know how long the government expects you to live, and then of course, base financial decisions around it, but that's what we have, and that's the table there. All you're really going to do if you want to know your specific RMD is going to be take your total value of your qualified accounts, and then you're going to divide it by the number that the IRS provides to you based on the age that you are, and then you're going to have your amount that you're expected to take in that year. So that's going to be a fun little side project for you here. So when is your first RMD due? Well, for simplicity's sake, we'll break it down and say if you were born before 1960, it's going to be 73 years old, and if you're born after 1960, it's going to be 75 years old. So that'll represent the first time that you have to take your RMD. Now, when we talk about the year that you turn this age, so whether it's 73 or 75, you are expected to take your RMD in that year, but you can choose to delay it until April of the following year, right? So if you turned, so let's say it's 73 in 2025, you are allowed to wait until April of 2026. The only catch is if you do wait, you have to take two RMDs in 1 year, right? You have to take the 2025 and the 2026 one both in 2026. Now let's talk about why RMDs even exist in the first place, because I know that these are the bane of a lot of our clients and they bring a lot of frustration. RMDs exist essentially because the IRS wants to collect payment from you for the benefit of allowing you to defer taxes after all of these years, right? It wasn't enough for them to collect income tax for you for 40 years during your career. Now they also want to collect tax from you while you're in retirement, and RMDs is their way to do so. RMDs make sure that the retirement population is continuing to pay income taxes, and it's their number one way to do so. Remember, the only way that the government has to bring in revenue is taxes. Unfortunately, the penalty for missing a required minimum distribution is 25% of what you should have taken. And that can be pretty substantial, right? For some of you, you're gonna have an RMD of $100,000 in a given year, and the penalty there would be $25,000. Now, I will add in a quick footnote here that if you get this corrected quickly, as the IRS puts it, it's only going to be 10% penalty, but you want to be very mindful of your RMD date. So let's talk about why RMDs matter so much in retirement planning. And as I mentioned at the start of the video, why it can help to pre-plan far in advance for these required minimum distributions. And the biggest thing here is that they can potentially push you up into a higher tax bracket. In the same way that it works with your income when you were in your career, it's going to work the same way with your RMDs. It's going to be taxed as regular income. It's going to be based on a progressive tax system, meaning the more that you make, the more that you're going to have to pay in taxes. But there's also some consequences that come to jumping up tax brackets. The first being is you're going to have to pay more of your Social Security in terms of how much is taxable. The second thing is you're going to have to pay more for something like Medicare's Part B and D. Generally speaking, Medicare Part A is always going to be free to you, but the other pieces, B and D, are going to depend on your income. So right off the bat, just by jumping up a few tax brackets, you could be costing yourself a couple extra $1,000 per year, maybe even more than that, by having large RMDs. As I mentioned a moment ago, it's always great to have income flowing in retirement, but if we can manage that tax tsunami that we're getting hit with in retirement by planning early on, it's always ideal. Now let me finish here with some strategies, right? Some strategies to avoid this large tax tsunami or tax time bomb, however you want to refer it, and some ways to focus on taxes with your RMDs. So the first and probably most popular strategy to avoid future RMDs is to start doing Roth conversions now. Now, really all a Roth conversion is taking a pre-tax asset, turning it into a post-tax asset with a present-day tax due. Essentially what you've done is you've agreed to pay the tax today in favor of not having to pay it into the future. A lot of people have a large 401k or a large traditional IRA that they've built up during their career, and not having that Roth IRA really hurts them in retirement because it forces them to pay more taxes, more than they ever expected, and that is because of these RMDs, and it's because 100% of your withdrawal from an account like an IRA or like a 401k is taxable, where if we compare that to a Roth IRA, which is not taxable at all, and it doesn't add to our income, you can see a substantial difference. So Roth conversions for the right person, depending on tax bracket and age, can be helpful. The second piece I want to mention here is a qualified charitable distribution, okay? This is for all of you out here who are kind-hearted and like to give to a church or a charity. Know that after the age of 70 and a half years old, you can currently give up to $108,000 per person per year from your IRA directly to a charity or a church, as I mentioned. This does two things. One, you don't have to give an after-tax asset like cash, and you can give an asset that has grown up substantially, like a stock or a bond or a mutual fund, and you can give this to your church, and at the same time, you can also satisfy your RMD. So let's go back to my example where I said someone had a $100,000 RMD from their IRA or from their 401k, and they decided rather to give $100,000 to their church. Now I know that's a substantial amount and that's a very happy pastor, but the one thing I want to mention here is that yes, you can already give that RMD to the church, and it's going to not only make the donation and give you fulfillment, it's also going to satisfy the RMD for that year. So the IRS is not going to tax you, and they're not going to come asking and looking for that $100,000. Now, a third thing I quickly want to mention here is focus on building other accounts that are not pre-tax, present day. So if you're someone in your 40s, 50s, 60s, keep in mind that having that Roth IRA, having that taxable non-retirement brokerage account can be very helpful. As I mentioned a moment ago, a lot of people do build up their retirement savings in a pre-tax asset like a 401k or like a traditional IRA. And it's better to save than not save at all, but the most ideal state to be in is one that you have diversification in how you can choose to be taxed. So having all three of those different types of accounts can be very helpful for someone looking to retire. And with that said, always remember that these two other accounts, right? A Roth IRA or a tax-free account is not going to require RMDs, and neither is a brokerage account. So you also have that ability to choose not to take a distribution from those two accounts, which you don't have with the pre-tax account. Okay, I tried to fly through that as quick as possible. I hope this has been helpful, folks. A couple last notes here for you to take home with you. As I mentioned, make sure you know your RMD age. There's a lot of folks out there that get the 73 and the 75 mixed up. Being able to know an estimated first RMD that you're going to have to take might bring this into realism for you. So as I mentioned, just take your account value and divide it by your life expectancy depending on that RMD age, and always consider some proactive moves you can make in your 50s and 60s to control these future tax expenses and RMDs that are going to come. Be more than happy to walk you through our process with this, but as always, I thank you so much. Let me know if you have any other videos you'd like to see, but as always, I hope you have a great day.